In this video, traders, I want to look at, should you trade mini or micro futures contracts? Stay tuned. Hey guys, warm welcome to you. Thanks so much for joining me. All right, so this was actually posted, a question was posted in the area by Dan, I think it was, and he said, hey, micros, minis, what should I trade? I thought, what a great question, because at the moment, if you sit in the middle in terms of account size and volatility and how you trade and all this, it can be difficult to know, should I trade a mini, should I trade a micro? I mean, sometimes it's clear, if you've got a smaller account, then you're going to trade the micro. If you've got a larger account, you're going to trade the mini. But when a lot of traders sit somewhere in the middle, it's like, okay, what do I trade? Because there's a commission thing to consider. There's cost to trade, there's the volatility of the market to consider, there's the price per tick, all this kind of stuff. So I thought that's a great idea for a video. Let's do a quick video and talk about this. So first of all, let's just think, what are these? So we had, many years ago, we were trading in the pit, electronic trading came out and they said, hey, you can trade the S&P 500 contract in electronic format, let's call it the E-mini. And it would be a much smaller contract than the full fat pit contract. So it allowed people to trade electronically. It was the kind of first foray into electronic trading. It was a smaller contract size. It allowed maybe retail traders to get involved, etc., etc., etc. Now, fast forward to, oh gosh, when did they put the micros in? It feels like probably was a couple of years ago. Don't hold with that. Someone sent in the comments when they introduced them. Relatively recently, it feels like, but it's probably a couple of years. The micros came out and they were basically a tenth of the contract size of the mini. And so the idea the exchanges did this was to say, hey, retail traders, you can get involved. You can get involved at not much cost. You can get involved with the futures markets. You can get involved in trading, and especially when the volatility starts to pick up. Not necessarily volatility, more a case of the price of the asset started to increase, and over the years it got higher and higher and higher and higher, which meant that the daily ranges in terms of ticks were wider, which meant that the daily range in terms of monetary value of one futures contract was a lot more. And so exchanges said, hey, we can do a micro contract. It's a tenth of the size of the mini, and from there, from a business perspective, it's great, right? Because they can, another product they can give to the retail traders, and retail traders can get involved in that, and they can make commissions from that. And there's market makers going to be tagging it to the mini, all this kind of stuff. It's a great commercial move, and from traders' perspective, it meant they can access the markets they wanted to trade and not be subject to such wild swings, so smaller accounts could get involved. That's the point. And I'm a big fan of it. I'm a big fan of the choice and stuff, and hasn't affected liquidity for other markets. So you've got three main markets I like to consider. You've got the S&P 500, which trades under the ES. You've got the Dow, which trades under the YM, and you've got the Nasdaq, which trades under the NQ. Okay, now these are the big contracts. They are the mini contracts, even though now maybe we look at them as the big contract. They're the mini because they came kind of as a subset of the pit. So they're the mini contracts. And then the exchange came out with the micros, which are called the MNQ, MES, and MYM for the micro. And so basically they're a tenth of the size. So very quickly, per tick, the NQ is $5 per tick. So in other words, every quarter point increment is $5. So you're going to get four ticks increment in a 1 point. So every point the Nasdaq moves is going to be 20 bucks. If you go to the mini, that's 50 cents a tenth. ES, every tick is $12.50, $1.25 if you're on the micro mini. YM, $5 a tick. MYM is $50. No, it's not 50 cents a tick for the micro. Mini, micro, cents, all this stuff. You can get the idea, guys. So it's a tenth of the size, right? So you go, okay, what should I trade? Now, the commissions are still, they're reasonable. They're not a tenth of the size of the commissions. I think for most platforms, and I've not done a massive amount of research in this, but they are maybe half or a third, because the exchange fees are a lot lower. The exchange don't charge you as much because they recognize, hey, we can't charge people the same level we're charging here because they're getting a tenth of the move. It's going to take them many more ticks to break even. And so exchange fees are a lot lower. And many of the brokers as well are kind of, that's a small sliver most of the time the broker's putting in. It's the exchange fees, all this other stuff. So they're normally about half to a third of the price. So it's not a direct correlation. So you've got this decision where you go, okay, to get the same exposure, I need to trade 10 contracts of the micro for one mini. And that's going to cost you a lot more in commissions. And so if you're very, very active and you're trading 10 lots when you could be getting away with one, that's going to really increase your commission bill. So that's the downside. But the upside of trading the micro is that you get the flexibility to scale in and out. Now, obviously, if you're trading just one micro and that's your position size, then that's fine. The decision's made for you. But if you're at the level where you're like, okay, I'll trade 1 mini versus 10 micros, where am I? I think that trading the micros is something to consider, because even though you're paying a higher commission, you get the ability to be much more flexible with your position. So you get to trade 10 units, market goes your way a little bit, you can peel off 5, you can peel off a few more, you get to scale out. You don't have the all in or all out nature of a full mini contract where you go, okay, I've got no room to do anything here, I have to take this off. It's either all or nothing. And so you can't scale out, you can't scale in, you completely remove that side of your trading strategy, the scaling side. And so it's something to consider. And I think at the moment, with the volatility, the commission is negligible. Yes, if the volatility was much more contracted, you might have an argument and say, hey, I don't want to pay this commission because as a commission as a percentage of the daily range is quite high, so I've got to get a lot of moves to just pay my bills. And yeah, you could fall into that trap, and that's not a good thing. But if you're saying, hey, my commission is a very small slither of the daily range, which is kind of good metric to look at, then it doesn't really matter. It doesn't really matter. I can trade and it's moving around so much that it's just noise, the commission. And yes, it still matters in a perspective. It's still a bill to pay. It's still a consideration. The lower, the better. But ultimately, the flexibility of being able to scale in and out of a position, I think probably outweighs the commission bill that you're going to get, a higher commission bill from the same number of trades. Let me know your thoughts in the comment section below. I don't think it's black and white. I think there's considerations to have on both sides of the coin. But I think that if you're somewhere in the middle, the flexibility of being able to scale with the micros just pips the fact that it's going to cost you more to trade the same exposure. So you've got the NQ, ES, YM, of course you've got the stuff out there as well. These are the main ones, guys, micros and minis. And then liquidity is pretty decent as well, to be fair. Liquidity is pretty decent. They do a good job of tracking the mini, and liquidity is okay and reasonable enough to trade, probably accommodate most retail traders' size. And obviously if you wanted more size and you're trading hundreds, you wouldn't be trading in that, you'd be going straight into the mini. So it's about right for the product and where it sits. Anyway, let me know your thoughts on that, guys. Say, it's not black and white, me or micro. Which one do you trade? Which one do you recommend? Take care, bye bye.